Now I would like to invite our sponsor, Mr. Charles Whitmore from Guy Carpenter. He is the head of the global clients, to make his keynote speech.
Okay. Thank you very much for the very kind invitation. And let me also thank the conference organizers for inviting me to be with you here today. It's a great pleasure and a real honor. I work for Guy Carpenter, which is part of the Marsh McLellan Group. I'm based in London. We've been servicing the Turkish market for many years, and we very much look forward to servicing our Turkish clients and the Turkish insurance market and getting to that goal of taking the Turkish market to the top 10 over the next few years. So thank you for having me. Okay, next slide. I haven't got the clicker, so I'm reliant on my accomplice. The current insurance and reinsurance market is at an interesting point in its cycle. So I'm going to talk today. Thank you. I'm going to talk today about the current dynamics in the market. I'm going to make some predictions for 2026, and I'm also going to talk about how technology is shaping insurance placement from the view of the broker. Oh, wrong way. Okay. Oh, so let's start with original rates. So this is from Marsh's database of global commercial insurance placements across the world. And it looks at how original rate levels have moved by quarter since 2019. In the third quarter of 2024, rates fell for the first time since 2019, which represented an 18 consecutive quarter streak of increased rates. Since 2024, the rates have continued to reduce as a result of excess capacity in the market. But it's fair to say that original rating price adequacy is near all-time levels. Looking now at the reinsurance market, the Guy Carpenter Global Property CAT Rate Online Index reduced by approximately 6.6% in January 2025. And as we saw with the insurance rates, this is the first decrease in rates for around about 7 years. So in the same way, in the insurance market, price adequacy levels are still at very, very high positions. The US rates went down by about 6%, European rates went down by about 5%, driven by excess capacity and an absence of large, severe catastrophe events. And I think it's also interesting to see how rates move after severe loss events. And you can see that in some of these charts. In 2005, for example, after Katrina, Wilma, and Rita hurricanes in the US, you can see how the US pricing spiked. You can see the spike recently in Europe after Storm Bernd. And although the APAC market has been a little bit more constant, again, you can see how rates increased very significantly after the Japanese earthquake in 2011. I think when thinking about the reinsurance market, it's really important to start with a good look at losses, because losses drive the reinsurance market. The market is reactive to loss, and losses drive performance, and losses drive pricing. So the total insurance losses, or industry losses, for the first half 2025 was around about $80 billion. And that's 17% higher than the average for that period. But in contrast, the third quarter of 2025 has been very notable for the lack of large, severe cat events. I'll give you some context about how losses are developing. You can see that losses have continued to increase over time. And one of the areas, and one of the reasons for that, is that much of this loss activity has been caused by what we call secondary perils. What are secondary perils? Well, they are the losses that typically haven't caused insurers and reinsurers trouble over the years and have begun to recently. So losses such as flood, wildfire, severe convective storms, hail, drought. And these secondary perils are problematic because the models for these perils are still underdeveloped. And as a result, the insurance industry and the reinsurance industry finds it very hard to quantify the peril, finds it hard to price those perils, and therefore finds it hard to underwrite them. This chart shows losses by color, and the light blue losses at the lower end of the bars represent severe convective storms, or SCS, as we call them in the industry. And this has grown significantly, particularly in the US in recent years, fueled by climate change on the one hand, but also by growth in exposure accumulation in the Midwest of the US, and also by growth in asset values themselves. The other major loss source is hurricane, and you can see the hurricane contributions in dark green, and it makes up substantial amounts of loss in nearly all of the years since, well, pretty much since 2013, but particularly since 2017, apart from in 2025, where we have had really no losses, and we have our fingers crossed that this continues. The Karen Manmoras loss, your loss in 2023, is shown in dark blue at the bottom of the 2023 bar. One of the reasons for reinsurer strong results in recent years, and we'll go on and have a look at that in more detail, has been the change to reinsurer attachment points. In 2023, property cat attachment points, or retentions, increased in many territories to an average of 1 in 10 return period years for all perils, which was driven largely by the very significant losses that reinsurers were incurring due to the impact of secondary perils, which we saw on the previous slide. And because of this change in retention levels, reinsurers' shares of global cat losses has reduced from an average of 20% from 2017 to 2022 to closer to 13% since that date. The dark blue areas in this chart represent loss which is held by the insurers, and the light blue represents loss which has been ceded to reinsurance. So this reset of attachment points has meant that much of the secondary peril cat activity is being held by the insurers within their retentions. And there is a growing demand from insurers for products to help them manage this net retained volatility. When considering the health of the reinsurance market, it's obviously important to think about profitability levels. This chart highlights reinsurer cost of equity in light blue against reinsurer return on equity in dark blue since 2005. And it's clear to see that during the period 2017 to 2022, coinciding with those bad loss years that we saw earlier, reinsurers only exceeded their cost of equity twice, which for an investor is clearly a poor return. In contrast, since the market hardened in 2023, we see the reinsurers returned a return on equity of 22% in 23, 16% in 24, and they're set to deliver another 15 or 16% in 2025. It's also interesting to look at the market cycles in this chart. The pink background represents periods of value dilution, and the green background shows years when reinsurer value is being created. And these have followed each other over the cycle as the market has moved from hard into soft and back into hard again over the last 20 years. And meanwhile, how are the insurers doing, I hear you ask? On the left-hand side, we see the respective combined operating ratios of insurers in light blue and the reinsurers in dark blue. And so over the recent years, reinsurers have enabled their combined operating ratios to reduce to a level below 100%, and that's forecast to remain below 100, or in fact below 90 over time. And when we look at the relative performance in return on equity terms on the right-hand side, again, reinsurers are outperforming the insurance companies, but this time the differential is smaller. Further insights into reinsurer performance over the last few years. And I think it's useful to understand the contribution of underwriting and investment income when looking at overall reinsurer results. This chart shows that since the market hardening of 2023, underwriting income, and that's shown in the dark blue areas of the chart, has contributed a material amount to the overall profitability of our reinsurance composite. Prior to 2023, underwriting income was very patchy, and in some cases flat to negative. Meanwhile, income derived from investment portfolios has been remarkably consistent, and in recent years has been driven by strong returns from reinsurer fixed income portfolios due to positive movements in the bond markets. I always think that market risk capital levels can be considered as a barometer of the health of the reinsurance market. And if that is true, then the reinsurance market is in an extremely healthy position. Risk capital levels are at all-time highs. And the increases we are seeing in 2024 and 2025 are as a result of reinsurers deciding to reinvest their retained earnings from the previous year into what is a very positive trading environment, rather than giving the money back to shareholders by way of special dividends or share buybacks. And we anticipate that the same dynamics will remain going into 2026. The other key dynamic has to do with alternative capital. And here we see capital market investor appetite for reinsurance risk increasing significantly over the last few years. This underlines its attractiveness as a diversifying asset class to third-party capital. Not only are we seeing the continued rise in popularity and scope of the cat bond product, but we're also seeing alternative investors entering the reinsurance market by way of third-party capital sidecars, capital quota shares, and in some cases, structured products on a multi-year basis. And I think it's fair to say that the demand for reinsurance risk is high as we go into 2026. I mentioned the growth in alternative capital. So let's take a closer look at the dynamics in the cat bond market right now. Catastrophe bonds experienced record issuance in 2024. There were 67 different bonds issued, totaling more than $17 billion in limit placed. And the sponsor demand continued through the first half of 2025. So why is it that cat bonds are so attractive to buyers of catastrophe reinsurance? Well, there's three main reasons. Firstly, the pricing of the cat bond product has become more competitive. And there are certain modeled perils in the US where cat bond product is actually now cheaper than traditional reinsurance. Secondly, the investor appetite for perils has broadened, with capacity available for more perils as long as they can be modeled. For example, we recently placed the first ever cat bond for UK flood earlier this year. And thirdly, the cat bond product provides typically a 3-year duration of cover, which provides buyers with a very valuable hedge against the traditional marketplace and also enables them to diversify their risk capital sources. When considering market capital, it's also interesting to review capital inflows in recent hard market periods to better understand the composition and therefore potential appetite of that capital. In the direct aftermath of Hurricanes Katrina, Rita, and Wilma in 2005 in the US, over $20 billion of fresh capital was raised and put to work in new balance sheet rated reinsurance vehicles such as Ariel Re, Flagstone, Validus, and Lancashire. And after the great financial crisis and the resulting period of very low interest rates and clearly very low yield, $45 billion was pumped into the alternative reinsurance market by money managers seeking better yield than the 2% they were getting on US 10-year Treasury bonds. And in the most recent hard market, which we saw started in 2023, investors are in large part ignoring traditional new reinsurance startups because of the fact that investors can gain more direct access to reinsurance risk than ever before via the medium of cat bonds, of capital quota shares, and of sidecars. Retained earnings represent by far the largest source of new reinsurance risk capital in today's market. So, what do I think will happen in 2026? Well, we anticipate excess reinsurance capacity when set against a smaller increase in demand, largely driven by this effect of deploying 25 retained earnings into the 26 trading environment. And as we've seen earlier in this presentation, in addition, we anticipate increased capital market investor appetite, which will make alternative capital in all its different forms more hungry for risk. We also expect reinsurers to be more willing to trade rate rather than attachment point. So we think that cat structures will remain similar, but there will be greater pressure on reinsurance pricing levels. This gives our clients, the insurance companies and reinsurance companies, a wonderful opportunity to maximize their protections in 2026 and to purchase cover to optimize performance, to protect against peril volatility, to manage capital more efficiently, and to de-risk their growth strategies. And we also anticipate reinsurers demonstrating broad appetite for specialty lines of business, and this includes not only US casualty, international casualty, but also retrocession. And now a word on how technology is shaping placement from the insurance broker perspective. In the London market, the emergence of capacity that is bound automatically is a growing trend. And the syndicated nature of the London market presents a particular opportunity for this type of automated underwriting. And the shift has been driven by technology. In the past few years, smart follow capacity has increased significantly, both via algorithmic underwriting, which means all underwriting decisions are made systematically by an algorithm rather than by a human underwriter, but also via what we call smart trackers. And these are often syndicates that follow specific lead underwriters systematically on a portfolio basis. It's estimated that currently $5 billion of gross written premium is traded on this basis today in Lloyd's. So not only does automated underwriting have a clear advantage via its much lower cost base, which incidentally has been a long-term problem for Lloyd's, but it also has the flexibility to enter and exit markets quickly, which, if executed well, can lead to significant outperformance. Other advantages to this strategy include a greater certainty around allocated capacity, access to portfolio data, greater market relevance, and a broader and a better diversified portfolio. So what does this mean for the insurance placement? Well, the left-hand chart shows how the market used to work. The broker would establish a lead panel, typically between 10 and 30% of the placement, and then approach following markets on a risk-by-risk basis to generate 100% placement. But this approach is changing rapidly, and the chart on the right shows how. Lead markets are still very important, but the broker facilities and the smart follow syndicates are now taking up significant amounts of the follow capacity on an automatic basis, which is squeezing the open market placement. Insurers that neither have the underwriting expertise and reputation to lead, nor the efficiency to purely follow, will get squeezed out. Insurers will need to decide if they are a leader or a follower in each line that they underwrite and allocate resources accordingly. Those insurers who want to lead must continue to invest heavily in product development, distribution, and claims operations. And where they want to follow, the focus must be more on efficiency, data, and how to get the best out of smart follow facilities. About 5 minutes ago, I received a note saying I had the last 5 minutes, and so I think hopefully I've timed that well. Thank you for having me here today on behalf of myself and all the Guy Carpenter team here today, and I hope you enjoyed the presentation.